ETFs or individual stocks? Which one should you be investing in? Well, in this video, I'm going to answer this question and give my thoughts on the pros and cons of both options. Let's get straight into it. An individual stock is a single company listed on the stock market that you can invest in. For example, Apple, Microsoft, or Google are all individual companies that you can buy shares in. So when you buy shares in these stocks, you essentially become a part owner of the company. An ETF represents a basket of many companies all under one stock. They act like normal stocks that you can buy and sell on a stock exchange. They can be a group of companies in the same industry or spread out across different sectors. Buying just one share of an ETF means you are effectively buying a tiny piece of many companies all under one stock. For example, NDQ is an ETF that tracks the top 100 US tech companies. So instead of buying Apple or Microsoft stock individually, you could invest in NDQ, which contains Apple, Microsoft, and about 98 other US tech companies. Or if you're only interested in Australian companies, you can invest in something like VAS, which is a very popular Australian ETF that tracks the top 300 Australian companies listed on the ASX like Commonwealth Bank, Telstra, and BHP. Another popular ETF is IVV, which tracks the S&P 500, which contains the top 500 companies in the United States. So blue chip companies like Nvidia, Tesla, and Visa. There are a few advantages and disadvantages to consider when trying to pick between investing in ETFs or individual stocks. Let's start with individual stocks. The biggest advantage of investing in individual stocks is the potential for a higher return. You can make significant gains if you pick the right company, especially if you pick a company that is still going through a growth phase. So imagine you invested $1,000 into Tesla stock back in 2019 when the stock was around $15 per share. If you held on to those shares until today, that $1,000 would have increased to $17,000. I mean, this is a bit of an extreme example, but you get the idea. So picking the right stock at the right time can result in substantial returns that will most likely outperform the broader market or ETFs. Well, at least in the short to medium term. However, this comes at a higher level of risk. If the individual company performs poorly, it can lead to significant losses. If you only invest in a few individual stocks, then any poor performing stock will cause a significant dent in your portfolio. Another advantage is you have full control over your stock selection. This allows you to align your investments to your specific circumstances, goals, and beliefs. You can be the captain of your ship, and just a pro tip, no one cares more about your money than you. However, the disadvantage is that picking your own stocks will be more time consuming for you because you need to research and monitor your stocks. Picking the next Apple or Tesla does require extensive research and ongoing monitoring, which can be both time consuming and challenging, especially for new investors. But luckily these days, there are tools you can use to help you research quicker by having everything in one place. And I personally use the Moomoo app to do my stock research. Moomoo is an AI-based trading app created in Silicon Valley that allows even new investors to invest like a pro. It's free to download and contains heaps of free research and analysis tools. When you are buying individual stocks, you want to be doing proper research and not just buying blindly because some guy at work told you to and hoping for the best. This is where Moomoo's AI-driven research features come in. Their app offers a ton of research features that will help you study the financials of a company as well as other useful stats. For example, if I was interested in Apple stock, I can go into the app here, click company, and there'll be a ton of information for me to research. So I can see things like the analyst ratings from some of the biggest firms on Wall Street, and if I scroll down further, I can see the operating data, revenue breakdown, financial estimates, financial indicators, income statement, balance sheets, cash flows, and all the other stats you can think of. In addition, I really like this institutional tracker feature that allows you to peek inside the portfolio of some of the most famous investment firms. So for example, Berkshire Hathaway, which is run by the legendary Warren Buffett. You can see the list of their current holdings as well as any increase or decrease of current stocks they own. In addition, you can see any new stocks that they have added and any stocks that they have sold out. So this allows you to gauge the market sentiment for certain stocks. And of course, this will help you with your research to find the next Apple stock. I have tried many investing apps in the last few years, and Moomoo is definitely one of the most robust apps out there in terms of research and features. And unlike other brokers in Australia, they have pre and post market trading, which offers 24 hours trading for some of the most popular stocks in the US market. And if you are interested in buying US stocks, then you could use the Moomoo Australia app, which allows you to invest in US stocks from Australia for a very reasonable price. I was previously using Stake to buy US stocks, but have recently switched to Moomoo due to their lower fees and useful stock research tools. You can buy US stocks for as little as $2 per trade, and the most you're likely to pay is around $3 for larger parcels. And you can actually work out the price you're likely to pay on their website. And compared to other brokers, they have one of the lowest foreign exchange fee. Not the lowest, but pretty low. And here's the best part. Since I know you guys love free stuff, they are offering a very generous promotion right now where they are giving you 180 days of free brokerage fees and up to 15 free shares. So you don't even have to pay for brokerage fees for 6 months. Here's what you have to do to claim the offer. If you sign up using the link in the description below and deposit any amount, even $1 will do, you will receive 180 days of free brokerage fees for both US and Aussie stocks. You will also receive a lifetime access to Moomoo's Learn Premium feature, which teaches you many things about the stock market. So it's perfect if you're a beginner and still learning. In addition, if you deposit $100, you'll receive 3 free random shares plus all the bonuses I mentioned. If you deposit $2,000, you'll receive 8 free shares plus all the bonus I I just mentioned. And if you deposit $5,000, you'll receive 15 free shares plus the bonuses I just mentioned. And then all you have to do is maintain this value for 30 days in your account and the free shares will be yours. After that, you can choose to sell the shares for a profit or choose to hold on to them long term. You really can't lose. And yes, it does work. I have tried it myself and have received my free shares. And no, there is no catch. You will get free stuff. This offer is valid for a limited time only, and I'm not just saying that, I really don't know when it will end. But one thing is for sure, usually a new broker will become less generous with every new promotion. And since Moomoo are still relatively new in Australia, they can still afford to be generous, but it won't last forever. So if you are interested, make sure you take advantage of this deal and click the link in the description and make your first deposit. So let's talk about some advantages and disadvantages of ETFs. The biggest advantage of investing in ETFs is diversification. Since ETFs are basically baskets of many companies, they help spread risk and reduce the impact of poor performing individual stocks. For example, IVV is an ETF that tracks the S&P 500, which is made up of the top 500 US companies. They will have a panel of people that will monitor the performance of every company in the ETF. And the ETF is continually updated to remove any underperforming company with a better performing company every year. The main disadvantage of ETFs is that your returns may not be as high as if you invested in individual stocks. Usually you can invest in an ETF that tracks an index and expect a 7 to 10% average annual return in the long term. Of course, this is not guaranteed, but it is the historical return in the last 100 years of the stock market. This will most likely make you wealthy in the long term, but you won't have any moonshot gains in your portfolio where a stock goes up exponentially. You also have limited control of your investment. ETF investors do not have control over individual assets that they are investing into. So you can't pick and choose specific stocks to include or exclude from your portfolio. You basically leave the choice to the ETF managers and trust that they will invest your money well. And just a quick disclaimer, I am not a financial advisor and this video is not financial advice. The information and stocks I mentioned in this video are for educational purposes only. I am not recommending to buy them, nor am I trying to influence you to invest in a particular way. I'm just laying out the facts for you and it's up to you to do your own research. Please remember that all investments, including both stocks and ETFs, contain risk and nothing is ever guaranteed. If you would like financial advice, then please go see a professional. Having said all that, let's move on. The next advantage of ETFs is the convenience. Investing into ETFs is very easy and simple. It doesn't require much brain power. You can build your wealth slowly by dollar cost averaging into an ETF. Dollar cost averaging is a strategy where you buy shares of an ETF in regular intervals over a certain period of time. For example, you can choose to invest $200 every fortnight when your pay comes in, no matter the price of the shares at the time. So this means you'll invest $5,200 every year, which does add up. And the idea is, by consistently doing this, you will get the average return of the market in the long term. This also makes it less emotional, especially for new investors. You won't have to worry about panic buying, panic selling, or trying to time the market. You just have to show up every fortnight and invest through rain, hail, or shine. The disadvantage here is that you'll have to pay a management fee. Even index ETFs that track popular indexes like the ASX 200 or the S&P 500 will charge you a management fee. But to be fair, the management fees are usually quite low for these types of ETFs. Usually the more unique or niche an ETF is, the higher the management fee will be. For example, HACK, which is an ETF that tracks the leading cybersecurity companies in the world, charges 0.67%, which is quite high compared to a popular Australian ETF like ASX 200, which only charges a measly 0.04%. And the management fee is already baked into the share price, so you don't actually have to pay it out of pocket. It will automatically be deducted from the share price. So there are pros and cons from both sides. So what should you invest in? Well, I don't know your personal circumstances, so I can't tell you what to do. It will be different for everyone and where they are at in their investing journey. But here is what I'm doing. You may be wondering if I'm team ETF or team individual stocks. Well, the answer is I actually invest in both. I think investing in ETFs, especially ones that track a particular index, is a solid foundation for your portfolio. I also choose to invest in individual stocks to improve my own knowledge of the stock market and to potentially get higher returns to accelerate my wealth. Now, if you're a beginner, it's probably better to have majority of your investments in ETFs and perhaps a smaller portion in individual stocks. Once you become more skilled as an investor, where you know what to research and look out for, you could potentially readjust your allocation. Now, keep in mind, I'm not 100% invested in stocks. I don't think anyone should be. I'm also invested in several other asset classes like real estate, cryptocurrency, among other things. But I would say 70% of my stock market allocation is invested in a few ETFs that tracks the Australian, US, and emerging markets. I regularly dollar cost average into these ETFs every month and it has worked very well for me so far. So all the ETFs in my portfolio are listed on the ASX. You could also invest in popular ETFs listed on the US stock market like VOO, which tracks the S&P 500. The only downside is then you'll have to deal with the currency conversion and taxes from your dividends since you are based in Australia. So for this reason, I prefer to invest in ETFs that are domiciled in Australian dollars so that it's easier for me to track the tax and to set up automatic dividend reinvestments. So in this case, the Aussie ETF equivalent to VOO is IVV. The only difference is IVV is domiciled in Australian dollars. So if the Australian dollar is doing well, then your ETF will also be doing well, and vice versa. And the other 30% of my stock market allocation is invested in several individual stocks. At the moment, I'm not really investing into individual Aussie stocks. I do have a few that I hold from several years ago, but these days I prefer investing in Aussie ETFs for my Australian allocation. Most of my individual stocks are from the US market because I feel it's easier to research and to find companies that I like from there. And let's face it, all the top global companies are from the US whether we like it or not. I mean, when was the last time you went a whole day without using a Google, Apple or Microsoft product? I actually can't remember myself. I mean, you're watching this video from an American app and probably from an American device. Since the US has a much bigger global reach, I find that you're more likely to find some gems early with big potential returns. And once again, if you're interested in buying US stocks, go check out Moomoo and get yourself some free shares and 6 months worth of free brokerage. And that includes free brokerage for both US and Australian stocks. And if you want to learn how you can easily buy your first US stock, then go check out this video on screen where I show you how to do this. As always, thank you for watching, I appreciate you, and I'll see you in the next video.